Good afternoon, traders and investors. Will back here with another one, coming to you with a Wednesday market recap. Hope all of you had a very good day of trading. And in today's markets, guys, well, the bulls continue their absolute monster rally forward, guys. Even the jobs data that we got this morning that came in less favorable than expected was not enough to deter the rally. This rally has definitely been one of the most record-breaking rallies that we've seen in the last 4 years of trading. And it just goes to show that this market is maybe proving to be a lot more resilient than a lot of people might have assumed. So in today's video, guys, we're going to go over a few things together. Number one, we're going to cover that jobs revisions data report that came out this morning and see possibly why the bulls just did not care even if the data was less than favorable. And in point number two, we're going to be going over a few earnings reports that I have prepared for you guys. Those are going to be Target, TJX, and Snowflake. So those will be in part 2 of the video. Thereafter, of course, we're going to go through our major technical analysis rundown of our major stock market indexes and then our big tech names and see possible levels of price action for some supports in the event we get some little pullback soon. And then lastly, guys, take a look at my portfolio to look at the trades made today and the ones that I have on for the remainder of the week. So without further ado, guys, a lot to cover today. Let's jump right into it. SPY up a very healthy 0.34%, QQQ up a very healthy 0.47%, and really all across the board here today, guys, it was a very healthy market to say the least. As you can see, big tech performance, relatively mixed, but no real outliers to the downside. Semiconductors having a very good day as well. Financials retracing a little bit, but that's okay. They've been outperforming over the last 2 weeks, so a little bit of a breather would not be such a bad thing. And even healthcare also mixed, but did end the day up. And the bottom half of the market, guys, your more consumer defensive names up here, and then your industrials and value-oriented names, those did very well as well. So all in all, guys, a very broad-based market rally day once again. Take a look at your one-day relative performance, guys. You'll see that even better, pretty much everything in the green. And on the last 1 week relative as well, almost everything in the green, everything except for energy. Energy's been kind of down a little bit just because oil prices have been steadily declining pretty much now for the past week and a half. So before we get into more technical analysis, guys, let's jump right into that jobs data report from this morning and see, even though it came in less favorable than expected, why maybe the bulls just didn't care. So let's take a look at the headline number here, guys, right? We all remember that yesterday we were possibly forecasting a miss, or rather revision to the downside of up to 1 million jobs. Just keep in mind, guys, they do these revisions pretty much once per year, and right, how they derive the data in the first place is by monthly surveys. Then once per year after tax season, they compile everybody's unemployment claims from their tax reports, obviously, and then revise the data to the downside. So we were keeping out on for any number, guys, that was going to exceed 501,000, because that would be pretty much a downward revision larger than we've seen in the last 6-7 years of trading right here. So that was what we were leading into. And the data today, so the worst estimate was for about 1 million jobs less than we had previously forecasted in the economy. And the data came out very close to that. So added 818,000 fewer jobs than thought, adding concerns about the economy. So let's move down here, guys. And I only highlighted one single thing. Each year, the Bureau of Labor Statistics uses state unemployment insurance tax records to paint a more accurate picture of the jobs market compared with its regular monthly surveys. So obviously, guys, that is pretty much how they derive these new revisions to the downside. And as we can see here, guys, right, even after these large downward revisions, the labor market looks to have been on solid footing. So all of that being said, guys, we did add significantly less jobs than anticipated, but why did the bulls not care? Well, largely because leading into this event, guys, people were predicting that the jobs market was still going to be relatively weak. So to get some real downside performance in the markets today, we would have needed a big miss beyond the 1 million decline, which was the steepest decline, which was polled by analysts, right? So anything above that probably would have warranted a little bit of a sell-off. But since we came in under that, pretty much within the average of analyst expectations between 600K to about 1 million to the downside, well, the bulls just did not care. The data was not weak enough to show that the economy was weaker than already currently expected. Everybody knows right now that the labor market is slowing down, the economy is slowing down, and consumers are pulling back on their purchases. But we are going to need some very large negative headlines, guys, to get into those recessionary fears once again. that is why, in my humble opinion, the bulls pretty much did not care. We know we have rate cuts coming in September, and there's forecasted to be at least 3 cuts before the end of the year. So traders and analysts largely still predicting that soft landing scenario, even if we do have a little bit of a slowdown right there. So that's pretty much everything for the jobs data. Keep in mind, we do have more data tomorrow. We have initial jobless claims early on in the morning. We have our manufacturing PMI. Got to keep a close watch on this one. This is one that made the markets drop about 3 weeks ago. And then you also have the services PMI too, and the start of the Jackson Hole Symposium, where you have central bankers from around the world that come together to talk about their world views, the world economy, and also the direction of inflation and worldwide interest rates too. And a lot of emphasis will be put on Jerome Powell's speech that is going to be coming Friday morning. So all of those events tomorrow could lead to a little bit of volatility here, guys. But as of now, the bulls remain in full control. So let's now jump into some of our earnings that we have, right? So let's start off with a very nice company, and that's going to be Target. So let's take a look at Target, guys. Target jumping on the day 10% to the upside. Now, I'll be first to admit, guys, I did not expect Target to have such a wild jump in share price after their earnings. Now, obviously, we just got Walmart last week, but we know that Target is not the same company that Walmart is. Walmart is more of an international brand with a ton of exposure and a lot larger business, right? Target is kind of an in-between, situation, right? They are a fairly large retailer, but outside of North America, they don't really have much footprint at all. So taking a look at their earnings here, guys, earnings were pretty good for Target, admittedly. So their quarter came in double beat and a nice little raise on guidance as well. So we had a nice beat on EPS here by about 18%, nice little beat on revenue by about 1%. Let's jump into Target's news article right there for their earnings and then discuss their share price. So Target shares spike as profits rise despite cautious sales outlook. So let's take a look at it. So Target said that sales grew about 3% in its fiscal second quarter, a return to growth after a prolonged stretch of sluggish sales and squeezed profits. The company stuck by its previous full-year sales forecast and struck a cautious note. Target said it expects comparable sales for the full year to range from flat up to 2%. So either 0% growth up to 2%, but now it said it expects the increase will likely be in the lower half of the range. So 1% or less pretty much, but at least it's still positive. Now, Target raised its profit guidance, saying that they're now expecting EPS between 9 to 9.70, up from the previous range of 8.60 to 9.60. So there's your increase in guidance. Now, moving forward, while we've been pleased with our performance so far this year, and our view of the consumer remains largely the same, the range of possibilities and the macroeconomic backdrop in consumer data and in our business remains unusually high. So still uncertain, guys, about the footing of the consumer right now. Very normal, much in line with so many other earnings that we've seen from so many other companies over the last 6 months. Target, known for its wide array of trendy but low-priced merchandise, has been hurt as customers buy fewer items like new outfits or home decor, while they pay more for everyday expenses like food and housing. The big box retailer also struggled with reduced profits in recent quarters as customers purchased items like groceries that tend to be lower margin, and losses from damaged inventory and theft, including organized retail crime, took a toll. So here's your net sales, guys. What I want you to notice is they've been doing a great job of pushing for more online sales. That's that light blue category up here. And that's one of the reasons why their profit margins have not been eroded. Target's been having to do a lot of sales and promotions in stores to really stimulate demand. Now, usually that does offset profit margins ever so slightly because you're liquidating merchandise at lower than you would have anticipated, right? But their online store presence, which is a more efficient business with higher profit margins, is coming to kind of save the day in that respect. Now, comparable sales climbed 2% in the quarter, the first time in 5 quarters that Target posted a gain. Here are your same store sales. As you can see, that is what that's just said, guys. First time in 5-6 quarters that they've seen an increase in same store sales. So looking not too bad there. Now, moving forward, digital sales drove most of those gains, growing 8.7% in the quarter, as I was saying, as more customers used same-day services like curbside pickup and home delivery. Comparable store sales rose slightly, up 0.7%. So there is the reason for your massive growth, guys. It is definitely the online space. Target has tried to rev up sales and drive higher foot traffic by deepening loyalty and offering discounts. The company relaunched its loyalty program earlier this year and introduced a new paid membership, trying to pull a Costco. Walmart also copied them, started that service 2 years ago, and now Target's trying to do it as well. Now, Target threw in its own sales event in July to compete with Amazon's Prime Day, and it announced in May that it would cut prices on about 5,000 frequently bought items, including diapers, milk, and paper towels. When I read this, guys, I think of one thing. The company has no more pricing power, and it's the same thing pretty much for a lot of your retailers out there. A lot of people are forced to reduce prices. Now, here's what the CEO had to say. He said that customers have responded well to the price reductions and credited them for contributing to traffic growth in the quarter. So that's pretty much the news article for Target. As you can see from this little infographic right here, traffic grew finally by about 3%, and your operating margins, the profit of the business, right? Operating profit were up by about 1.6 percentage points to about 6.4%. So retaining a lot of that, a lot of those profit margins as a whole, right? So very not too bad of a quarter for Target, as I said, but they obviously have a few headwinds ahead of them, such as the consumer landscape that we're operating in right now. So moving on in, guys, in terms of the valuation of the company, right? Not much else to see from their earnings or their earnings slides or really their financial statement breakdown, guys. It's pretty much more of the same as we've been seeing, right? Trying as best as they can to reduce costs, keeping efficiency as high as they can, but trying their best to battle those reductions in revenue and in demand. So take a look right here, guys, in terms of their balance sheet. Well, their balance sheet is not too bad, right? So you take a look here. They do have $21 billion in debt. They only have $1 billion of cash on hand, but they do bring in a decent amount of free cash flow per year, guys. I wouldn't be too worried about their debt profile, even though it is a little bit high. It could be a lot worse. And when the company is bringing in over $100 billion in revenue per year, I think this debt to revenue metric is fairly manageable. Even though it's not the best balance sheet, I wouldn't say there's anything to truly worry about right now. Moving on into their growth metrics, as you can see, EPS should be steadily expanding over the next 4 years, and revenue, although revenue will be flat not only this year but even into 2025, as consumers are slightly weak right now, 2026 and 2027 should be resuming to growth after we get through this stage in the economic cycle. Now, in terms of the profit margins of Target, I wanted to highlight the profit margins, right? Because that is what they seek to protect. So obviously you see they dropped off a massive cliff here in 2022 when they had to battle with high inventories, supply chain constraints, rising prices, inflation, and all of that good stuff. But now you can see not only the top category right here, their gross margins are now improving, still not back to pre-pandemic levels. Same thing with their operating margins. They are improving. You saw that headline. Now they're about 6.4% for the quarter. So they are better, but still not back to pre-pandemic levels consistently. And your net margins also, net margins at about just under 4% right now. That is fairly standard in the company's history, but I'd like to see them those get back over 4%. Now keep an eye also on their price to earnings ratio right now. Well, as a matter of fact, let's do the valuation, and then we can cover that chart right there. So in terms of the valuation here, guys, well, Target is growing revenue right now at about, let me just get my brush right here, at about 2.8% per year. Definitely weaker than Walmart in that respect. And their EPS growth here is about 9% per year. That's not too bad, which gives them a forward P at 159 of about 36.9. In relation to the company's history, guys, this is relatively high, right? Right now, they're operating at a trailing price earnings ratio of about 16-17. So to see them all the way up here at about 36.9 is still fairly high. And even if we were to take their, excuse me, I think I have the wrong metrics right here. 933, my bad. I must have copy pasted this from somewhere else. So 933, let's redo that real quick. My bad right there, guys. So let's just redo it real quick. Hitting too many buttons here. So moving on into the Target numbers, you guys can see me struggle in real time. Must be fun, right? So moving on into the Target valuation, let me just redo it real quick. 159 divided by 933 gives them a forward P of about 17. That makes a lot more sense. I thought something was wrong there. And then we divide that by their, so I did get the EPS growth rate and all that good stuff right. So let's do this one right here. 1.89 is their PEG ratio. So as you can see, the PEG is relatively high. Their price to earnings, my apologies for the mistake there, is relatively in line with the company history, but you can see you're not getting a tremendous discount at all. If anything, you're paying slightly to the higher end of their most recent price to earnings ratio history, and their PEG ratio at a 1.89 is ever so slightly rich here, guys, right? When we covered Walmart the other day, we saw pretty much for all intents and purposes the same thing, right? They do have a very high price to earnings ratio, Walmart, and even a high PEG ratio. But the moral of the story for these companies, when you have a more defensive company, more of a value-oriented name, you really have to look at the free cash flow yield or price to sales or enterprise value versus EBITDA, stuff like that. But I like the free cash flow yield. So at 6.2%, this is actually pretty good, guys. Moral of the story, if Target can continue just protecting their business and then resume to business as normal when we get out of this economic downturn, they should be positioned to operate very, very well right now. So at 6.2% free cash flow yield, it's really not that bad of a deal. In terms of where I like it more on the technicals, has to be down in this lower support range, guys. I do play Target every now and then with some short puts, and I would like to play them again if we can get another discount back down to 145 to about 135. If we sell off because maybe the economy gets bad or something like that, I would be willing to give this company a chance, but I would need to get as close to 130 as possible for this trade to make sense for me. So Target, all in all, decent earnings, but they do have their headwinds. And in terms of the valuation, guys, it's not so cheap that it's screaming massive opportunity to me, in my humble opinion. As a matter of fact, at these metrics right here, Amazon actually is a cheaper company despite being closer to the all-time highs if you're looking for a big box retailer. So moving on further, guys, we're going to tackle company number 2, and this one is actually one of my favorite retailers in the entire stock market, guys. Funny story, when I was looking to build a retailer into my long-term portfolio all the way back in the late part of 2018, I was looking to add one company and only one company, guys, because with retailers, especially fashion brands, it's very difficult to have a moat, right? As I wrote right here on the company earnings, fashion trends change, which is why I have so many problems with a lot of fashion businesses out there, such as Lululemon. So fashion trends change, but the business model is what keeps you alive. Do you have a moat around your business model or not? And in my opinion, guys, there's only two clothing retailers that are worth my money for a long-term investment, talking about the next 5, 10, 15 years. One of them is TJX, and the other one is the one that I went with, which was Louis Vuitton. So Louis Vuitton and TJX, when I was looking for one back here, TJX was trading at about a $45, $50 range. So now it's pretty much 2.5x, but Louis Vuitton has pretty much had the exact same returns from the time I picked them up, roughly around the $60 per share mark, 65 bucks. They also are up roughly a 2.5x. So I can't be too sad about missing out on this opportunity on TJX because I have one that has the same performance, but this one, guys, such a high quality company. It is one of the only two clothing retailers, as well with Louis Vuitton, that is on my high quality, high conviction stock list of high return on capital employed and high returns on invested capital. Two extremely important metrics when you're looking for a long-term investing opportunity. This company's return on capital employed of 28%. That is absolutely ridiculous, guys. And their long-term median is above 20%. And return on invested capital also at 23%. Extremely high. I love their business model, guys. It's a very simple business model. If you don't know what TJX Brands is, it's pretty much, well, Marshalls, Winners, HomeSense, but more specifically TJ Maxx as well, right? TJ Maxx, Marshall, and Winners in Canada, very simple business model. They basically go to all of your other main brands, such as Nike, companies like Ralph Lauren, companies like Guess, stuff like that, right? And they get all of their last season's apparel that has not sold, and they get them at deep discounts. Then they put them on their shelves and sell them back to us. To be quite honest with you guys, most of my brand name clothing comes from TJX. Rather than paying full price for things like Ralph Lauren or Guess or anything like that, right? I would rather just go to TJX and find those exact same articles of clothing for 40, 50, 60% off what you would usually pay for them at retail. Extremely solid business model. And even the newer generation guys, right? Your Gen Z are very, very good at, marketing for this brand. It seems that they like them a lot. So let's take a look at some of their earnings real quick, guys. In terms of their earnings, they absolutely crushed it. And as they should, guys. And this company is very defensive, usually in the face of any recessionary fears. So EPS beat by about 4% and revenue beat by about 1.16% too. TJ Maxx owner raises full year guidance, posts 5.6% sales gain for the most recent quarter. Now, extremely solid quarterly earnings, and even their guidance, guys, listen to this, raised its full year guidance after posting another quarter of strong sales. Let's move forward. The company has looked abroad as a primary growth avenue, and on Wednesday, it announced that it was taking a 35% ownership stake in the Dubai-based retailer Brands for Less for $360 million. Now, quick math, guys, that would put the company Brands for Less valuation at about $1 billion if they're buying 35% for $360 million. Now, the privately held brand is the region's only major off-price player and operates more than 100 stores, primarily in the UAE and Saudi Arabia, along with an e-commerce business too. So very nice investment with them, really goes along with their business model very in a complementary fashion. As TJX seeks to continue its global growth, this transaction gives the company an opportunity to invest in an established off-price retailer with significant growth potential. Now, we were a little disappointed in our Europe business, said the CEO. A decent size of that is our own execution. So notice they did not blame this on the consumer. They blame this on internal execution. This is what I like to hear from companies, guys. It is so easy to blame the macroeconomic landscape and the consumer right now, but if you can take ownership of that and see where you could have improved efficiency internally, that is usually very well received by the investing community. This is something that Estee Lauder has failed extremely miserably at in the last year and a half. During the quarter, consolidated comparable store sales increased by 4% and were entirely driven by an increase in customer transactions, not by prices. This is organic growth, the thing that you want to see the most, indicating more shoppers are coming to its stores. That jump is ahead of the 2.8% uptick that analysts had expected. Very good growth by them. So, during the quarter, Marmaxx, which is pretty much TJ Maxx and Marshalls and Sierra, Marmaxx comparable sales were up 5% compared with estimates of up to 2.9%, so beating the estimates by a landslide. Home Goods posted comparable sales up 2%, short of the estimate of 3%, however. So this brand, maybe not so much, but as the overall home furnishings market remains stagnant. We've seen that, guys, with companies like Restoration Hardware and Wayfair. People just aren't shopping so much for big ticket items right now, such as furniture, right? So we see excellent buying opportunities in the marketplace. This is what the CEO continued to say. We see excellent buying opportunities in the marketplace and are strongly positioned to ship fresh and compelling merchandise to our stores and online throughout the fall and holiday selling seasons. We marked a milestone for our company in the second quarter by opening our 5,000th store. Longer term, we are excited about our potential to capture additional market share in all of our geographies and to continue our global growth. So during this quarter, we've noticed a lot of different companies, guys, actually closing down stores, especially other retailers, right? But TJX continues its store expansion. Just goes to show you how healthy the company actually is. The retailer has been taking market share from its competitors like Target and Macy's, both of which reported earnings today and hinted at a weak consumer, funny enough, and has become a haven for price-sensitive consumers who may be watching their dollars but still want to spring for new clothes, especially brand name clothes, right, at a discount. Consumers will keep seeking value, said the CEO. In May, the CEO said the company is winning in part because it's become a cooler place to shop and has made inroads with younger Gen Z customers who tend to be more concerned with snagging good, high-quality deals than shopping at high-end names. So, secular trend being noticed right now by the company, and they are well positioned to capitalize on that. In Wednesday's earnings call, the CEO Herman said TJX is attracting an outsized number of younger customers. That is exactly what I like to hear. And now lastly, however, a sharp downturn in consumer spending, which some analysts have warned may be ahead, could impact the company regardless of its value offering. Same thing for even the strongest retailers out there, guys. TJX, Walmart, and even other food brands like Chipotle and McDonald's that have been performing well, if we have a very sharp downturn and a hard landing recession, well, obviously none of these retailers are going to be immune. They may be better positioned than their competition, but I wouldn't say they are necessarily immune, right? So moving on further here, in terms of their, one thing that they do very, very well here, guys, is share buybacks. That's why they have such good EPS. Take a look at their share buybacks from 2009, and you can see they've pretty much erased, I would say arguably about 60% of shares outstanding over the last 15 years. So very, very efficient company in terms of their use of capital. They still have about 2 to 2.5 billion in stock that they're authorized to repurchase through the end of February 2025. So 2 to 2.5 billion, guys. It's about a $135 billion company. So that's about 1.5% of shares outstanding, but they will continue to buy back shares, guys, every single year in the future, in my humble opinion. So the company is positioned extremely well. Now, in terms of their valuation, let's take a look at their financial metrics. As you can see, the profit margins of the company have never been fantastic, right? They've always been hovering between 7 and 9%. That's usually the standard, but it's pretty good for them. Now, in terms of their EPS expansion, as you can see, very nice EPS expansion and very nice revenue expansion curve as well. No problems whatsoever. This consistency and profitability, guys, is what I look for in long-term, high-quality investments. Moving into the valuation, revenue growth of about 5.6 per year. That's very good. EPS growth of about 9.2%. That gives them a forward P at 120 bucks of about a 29. At a first glance, that does appear high here, guys, but their price to earnings ratio history, guys, is usually in those ranges. Wall Street usually tends to give them a higher PE multiple just because of how stable the company is. As you can see here, guys, they usually always trade in the high 20s, right? You can find some periods prior to 2016 where they were below 20, but really since the onset of the pandemic, they've been trading really either mid 20s or low 30 PEs. So at 29, this is slightly elevated in relation to its history, but I wouldn't say it's crazy elevated. The PEG ratio here, guys, I've always said not the best to use the PEG when we have EPS under 10% growth, especially for more established value-oriented companies. What we need to do is use more specifically the free cash flow yield. And at about 3.1%, it's not the greatest right now, right? Usually you'd like to see this free cash flow yield between 3.5 and 5%, and that would really only happen if the company was on some sort of a dip. As a matter of fact, back in the late April, early May period, you would have had very decent free cash flow yield metrics, and the price to earnings ratio would have been a lot more manageable. So even though this company is one of my favorite companies in terms of fashion retailers in the game, just because of how they operate their business model, the valuation right now, guys, is very expensive. And if we take a look at the analyst forecast, you can obviously see that everybody is pretty much priced under right now. Not because they don't like the stock, but just because it's now achieved pretty much full valuation, even trading a little bit rich right now. So in terms of the pullback, in terms of what we could be looking at for pullbacks here, guys, it's the same with all my high quality conviction companies that I have in this list right here. We look at it on a monthly chart and we're looking to play the monthly higher lows after huge rallies, looking to always play those monthly higher lows. So if ever TJX comes down because the economic landscape continues to degrade over the next 2-3 months, I might be looking to pick up some shares if we can find it back here in the lower $100 range. Think 100 down to about $95. That would be my target range for the company, but chasing it up here, guys, is not the best risk to reward trade, and the valuation also isn't the most agreeable for you. So hopefully all of that makes sense for TJX. Gorgeous company, just a little bit high for me right now. You know, another one of the other favorite company that's not very high right now, which I put on the same line as TJX in terms of being so solid, is Louis Vuitton. Louis Vuitton still trading at very, very fair valuations right now, in my humble opinion. So that is the one that I've been buying as opposed to TJX. So now moving forward here, guys, let's jump over to a few of these other or actually one more company earnings is going to be Snowflake. So Snowflake was up during the day, but down in the after hours, down about 8.42%. Now, this company has been getting absolutely crushed over the past few years of trading ever since IPOing, and definitely wasn't helped by Warren Buffett completely selling his near $1 billion stake in Snowflake just over the most recent quarter. So a lot of people have been curious why Warren Buffett sold. He didn't give a specific reason to selling, but I'm pretty sure I know why here, guys, and we'll get into that when we get into the valuation of the company. Obviously, you guys know Warren Buffett is a big value investor, and when he does not see value in companies anymore, he tends to get out, and this is probably the case for Snowflake right now. So let's take a look at their numbers, guys. Why did they drop by about 8.5%? Well, let's have a look. They actually had a significant beat. So double beat here on earnings and revenue. EPS beat by 13%, revenue beat by about 2%, and they even increased their guidance, guys. However, it is just not enough for Wall Street. Let's jump into it right now. So in terms of their product highlights right here, year-over-year growth of revenue, 30%, which is decent. Net revenue retention rate, 127%. So not only are they retaining all of their clients, but every client that they do retain is paying more money into their services. Very nice. 21% year-over-year growth on total customers, and the amount of customers that pay 1 million per year is up 28% to about 510. Looking very strong in terms of their metrics at a first glance, right? Well, let's jump into a few of their slides and let's break down their business model. And you guys will see that the business is actually performing quite decently. They have partnerships, guys, as we saw in the infographic, right? Forbes Global 2000 customers, they have 736 of those. So you will notice that they are partnered with some of the largest companies in the game right now. NVIDIA, Microsoft, Salesforce, and the lists go on, obviously. You can go through all of these lists and you'll see so many extremely large companies that are partners of Snowflake. Snowflake is pretty much a data aggregator. They take all the data in your company and make it make sense, essentially. So here's your AI data cloud growth from April of 2020 all the way through now, July of 2024. So you can see that Snowflake services are definitely needed to make sense from big data to provide more financial or more metrics into companies' financials, into companies' customer service metrics, and things like that. So large and growing market. They are operating in a tremendously expanding market right now, which is your AI and cloud growth market. So very good total addressable market expansion for them. Now, in terms of their metrics, as you can see, guys, their revenue growing very, very nicely over the past couple of years. They're on every single quarter as well. They do have an increase. The problem is not so much in their revenues, guys. The problems are in their costs, and we'll get into that later. So they're highlighting that they have a significant amount of remaining performance obligations still. So a lot of money left in the pipeline for the company. Snowflake brings in right now just under, for this past year, just under $3 billion. The expectation for this year is, if I'm not mistaken, I think it's about 4.2. Let's just have a look. 3.5 as a matter of fact, so under. The next year is about 4.3. So that is about 1 year's worth of revenue for them in the pipeline still. So very good in terms of deals on the table. Adding quality customers. You can see their customer count. These are the 1 million in product revenue customers. Those are going up steadily every single year. Net retention rate, now it is still extremely high, even though it has been coming down. I see no problems with customer retention right there. And now we get to the good stuff. Notice how it says non-GAAP profit margins right here. So these are non-accepted accounting standards. The company is able to have very good profit margins when you look at non-GAAP numbers. However, when you actually look at real accounting numbers, GAAP standard accounting numbers, their numbers are not very good, guys. Snowflake has been struggling with profitability now, and it's been years and years and years. And as a matter of fact, you would be expecting, as they grow revenue, right? You would expect them to be able to reduce costs and bring these net losses lower and lower. But as a matter of fact, their net losses have been expanding as they grow the company. That is not very good. And that is my one big red flag with this company. So even though it says their non-GAAP operating margins are profitable, they are not net profitable, guys, not even close. Non-GAAP adjusted free cash flow margin, this doesn't even matter here, because even though they do post positive free cash flow on a non-GAAP practice standards, well, unfortunately, when it comes to real money, they have no real free cash flow to show at all for it right now. So in terms of that, guys, I want to dive into, that's pretty much all their slides that we're going to go over. So we know the revenue is expanding nicely here, guys, right? I'll show you this graph once again. We know that their revenue is expanding very, very nicely. That is not a problem for Snowflake. We know they're partnered with some of the largest companies in the game. Their product is good, and software developers, especially the people who work at Microsoft, Oracle, all other companies who use Snowflake's products, they love it. It's a very simple and easy product to implement in corporate structures for if you're a software programmer. At least that's what they all say. The problem, guys, is right here, and this is absolutely unacceptable for Snowflake, in my humble opinion, right? So let's break down their financial statements. I only do financial statements nowadays when there's anomalies, when there's something that should not be happening. I feel the need to show you guys right now. So here's your increase in revenue over this past year. As you can see, this is their 30% revenue increase they've been talking about, but cost of revenue is up 32%. So the cost of goods sold is exceeding the growth rate of the actual revenue itself. That is problem number one. Problem number two is they start at 73% gross profit margin. So you can see the cost of goods sold is not that much. They have a lot of gross profit right here, 73% gross profit margins. So where the heck do they spend all the money? How can you make close to almost $600 million in profit or gross profit margin and then end up with an operating loss of $355 million? Unacceptable, guys. Take a look at your sales and marketing growth right here. Sales and marketing growth over quarter-over-quarter growth right here from 2023 is up 16%, right? Yes, less than revenue, but still up 16%. And on a 6-month basis, it is up 19%. They could be doing a much better job of managing sales and marketing, guys. When you are already partnered with the largest and best companies in the game, how much additional marketing do you have to even actually do? Everybody knows about your product at this point, right? And you've probably at least touched base with most companies that are not your partners at least once so far. They need to bring this down. Research and development, I will give it to them. They are a software as a service company. They need those R&D expenses. However, growing 39% on a 6-month basis, growing 43%, well over the growth rate of the revenue. That is definitely a problem, guys. And it's not the R&D, it's because they include share-based compensation in all of this, and we'll get into that later. So a lot of this expense, guys, is not even R&D. Half of this expense is what they do for share-based compensation. And if you guys know how they do these financial statements a little bit, whatever they pay in stock-based compensation, they will include it in these 3 categories, right? So these are not the real expenses. Now, moving on to general and administrative expenses, those were up 16% on a 6-month trailing basis, 18%. So you can see, guys, cost control for this company needs to be a lot better. And a lot of that has to do with your sales your stock-based compensation, right? So we end up with an operating loss here of $355 million, which is larger than we had in 2023. Look at the 6-month basis right here. Loss of $704 million, larger than the 6-month trailing basis in 2023. How are you expanding losses, guys? It does not make sense. You have 73% gross profit margins. It's absolutely unacceptable that you are expanding losses when you have such high gross profit margins. And the reason for that, guys, is right here. Stock-based compensation, $356 million. Now, I've seen a lot of companies that have bad stock-based compensation metrics. Usually those are about 20 to 25%. A good stock-based compensation as a percentage of revenue should be about 10%. That is very manageable for a company to issue, right? But when you're talking about stock-based compensation in excess of 20%, that's where I start waving a little bit of a red flag, because you're spending your EPS could be a lot better. Your free cash flow could be a lot better if you didn't issue this many shares to management and employees. But look, in the 6 months as well, guys, right? $687 million, that is 41%. This is crazy, guys. This is absolutely unacceptable, right? If you were to remove at least half of this, which would be roughly, let's call it about $175 million, your net operating loss right here would be cut in half. Right? That is a very, very big thing. So their stock-based compensation, guys, this is absolutely unacceptable for this company. It's the one reason that I have never invested in Snowflake at all, guys, just because of that stock-based compensation and because of the valuation of the company as well. So it does have its positive points. Yes, it's the favorite platform for developers. They also have very high revenue and high EPS growth as well. They also do have a low amount of debt. This is true. So take a look right here in terms of their financials. They don't have that much debt at all. A lot more cash on the balance sheet and decent amount of free cash flow numbers. Even though this is non-GAAP free cash flow, that's okay. They still do bring in free cash flow per year. However, guys, right? 41% in stock-based compensation is absolutely unacceptable, especially when you're not yet profitable and have expanding losses. That is unacceptable, guys. In my humble opinion, These three reasons are why Warren Buffett sold the company, and these three reasons are exactly why I never invested in the company at all. Beautiful product. I like their product. I like their business model, but I do not like how they are running this company. Unfortunately unfortunately for me, I guess, unfortunately for them too, and unfortunately for all of the investors that have been in this company too. So revenue growth of 18% per year through 2027, good. EPS growth through 2027, about 54% per year. So take a look at these growth metrics. You will see they are expanding EPS and they are expanding revenue very, very aggressively. So the valuation will eventually get better, but right now it is absolutely terrible, even at $125 per share. Arguably some of the lowest share prices we've had in company history. You would think they're at a good deal right now, right? Well, unfortunately not. Their forward PE at $125 is 198. And even with all of this EPS growth, guys, the PEG ratio, is still 3.67. Anything above 2 is high. Anything above 3 is crazy high. And above 3.5, guys, I just cannot touch this company. This company would be fairly valued right now, literally if its share price got cut in half from here. Talking about $60, $65. I'm not saying it's going to go down there, but that's just what fair value would entail for this company right now. Even with these phenomenal growth metrics, I'm just not going to touch this company. So once again, a story of a company that unfortunately got destroyed by the Wall Street IPO process. They bid this one to the absolute moon. This company was supposed to IPO in the $140, $150 range, but because there were so many pre-IPO bids, guys, they ramped it all the way up to the high 200s, and then people pushed it up to $300. It just didn't make sense. This company, at best right now, the most that I'd be willing to pay for it is $90. $90 for Snowflake, in my humble opinion. So call me bearish, but that's just how I work with valuation. You guys know I can be very, very tolerant and very lenient on valuation sometimes if I like a company. But I like this company, but just these three reasons right here, guys, absolutely unacceptable for Snowflake. So I will probably, I'll keep an eye on it. I'll be revisiting it in the future, but we're going to need some activist investors right here to, to really hammer down on the company that they need to start addressing these three things. It is destroying their stock price right now and is contributing to just dilution. You're just getting continuously diluted every single quarter. You're getting diluted by more and more and more Snowflake shares that get put on the market, and the company doesn't even have anything to show for that dilution. They're still net margin negative, right? So very unfortunate for them. As I said, in terms of technicals, guys, in terms of a technical swing trade, yes, we are at a bottom area. If you want to take a lottery play on Snowflake for a little bit of weekly recovery, no problem at all here, guys. We are at the lower end of a technical range. I would not be opposed to playing this one as a swing trade, but just understand, your stop losses obviously have to go below the lows right here. And then we might be targeting maybe the 150, 160 range. So there is a swing trade right here, but just please do not risk anything that you're not willing to lose, right? That's pretty much everything for our earnings analysis. Hopefully you guys enjoyed that. Now let's dive right into our indexes, shall we? Give me a very quick second. And let's go. So moving into the SPY up about 0.34%, and we're going to go through these quickly, guys. Nothing has changed. We are still in this massive engulfing V-shaped recovery. So as soon as this move tops out, how do you know it's topped out, guys? You guys should know this by now. Loss of the hourly time frame. So if any of these points of data, or maybe Jerome Powell on Friday, are not nice to us, maybe only then will we lose this hourly trend and really start a daily consolidation period. But as of now, the bulls are in full control. As soon as we do pull back here, guys, looking for a daily higher low, anything above 510, just going to be looking for that daily higher low for possible further trend continuation. The level of pullback that I'm looking for here, guys, 545 down to about 535 could be a nice setup for possibly an inverse head and shoulders pattern, which would be quite bullish in my opinion. Moving into the Qs right now, Qs, exact same analysis, right? Huge V-shaped recovery bounce. We're just looking for when this bounce could possibly be topped out. So watch for the loss of the hourly trend into hourly downtrend, and that should be the signal. After that point, we'll be looking for a daily higher low. Anything above 423, just going to be looking for a daily higher low for possible further trend increase. Same inverse head and shoulders pattern could be shaping up. So I'll be looking for a pullback right around these moving averages. That is 467 down to about 457. This big box of support right there, looking quite good for the bulls. Moving on to XLF financials, same thing pretty much, but this one was a two-step recovery process. Gorgeous daily uptrend by the bulls, getting slightly rejected right now at the all-time highs. Very normal, big area of resistance. We are looking to set up for the daily higher lows at this point. Anything above 4210, just looking for a daily higher low for a possible daily uptrend shift, right? How do you know when daily consolidation is finished? Well, you can see we are now in an hourly downtrend, which means that we are in daily consolidation. Makes sense, right? So when we see the bulls recapture the hourly uptrend, that is when you know your daily higher low is set and we are looking to expand this trend higher. So financials right now looking very good. Once again, my favorite two names in the sector remain Visa and MasterCard, even though they've come up in the last couple weeks of trading and they're not still at the lows where we were buying them. I still do think these are amazing buying opportunities, guys. We're still just looking for the monthly higher lows for continued trend expansion. These companies will continue to print money over the next 5, 10, 15, 20 years, of course, right? So MasterCard looking very good, Visa looking very good as well for a little bit of trend expansion. Do not be dissuaded by the fact that we are no longer at these lows. MasterCard and Visa are legacy companies. They're not going anywhere. The upside in them is almost guaranteed over the long term. Now moving into XLV. Healthcare is looking also very good today, 0.17%. And this also, guys, is a two-step recovery process looking very good. So as soon as this move tops out, how do you know it's topped out? Keep an eye on the hourly trend. If you get an hourly confirmed downtrend, loss of the 12 EMA on the 1 hour chart, you know that your daily consolidation is underway. Then we're going to be looking for a higher low. Anything above 149, looking for a daily higher low for possible further trend expansion. I would maybe be on the lookout in the event that we consolidate and then maybe lose the daily uptrend into daily downtrend. I'd be looking out for a little bit of weekly consolidation. Keep in mind, we're in a gorgeous weekly uptrend right now, looking for a weekly higher low. And that's when, if we do start resetting on the daily here, because healthcare has been on a heck of a rally recently, if we do reset on the daily for some reason, I'd be looking for that weekly higher low in this range of support, that green box that you just saw, 151 down to about 150, which would pretty much be a breakout of the all-time highs, retest, and then run a bit further. Moving on to semiconductors right now. Semiconductors also not looking too bad, 1.04%, but we are still battling with this overhead resistance zone, right? That is pretty much 250 up to about 257. Big area for this ETF. So in the event we get rejected here, guys, and proceed into an hourly downtrend, keep an eye out for the hourly downtrend and the daily rollover. Just understand we're looking for a daily higher low, right? Anything above 211.25, just gonna be looking for that daily higher low for possible further trend continuation. Could also be a setup for an inverse head and shoulders pattern. So if ever SMH starts retesting these levels here, guys, I will be interested in individual names such as Micron, NVIDIA, AMD, ASML, TSMC, stuff like that, right? So if we do retest this big box of support, 238 down to 225, I'll be looking to shop for a few semiconductor names. And then possibly, guys, we just resume the rally to the upside. Semiconductors looking fairly bullish. Even on the weekly, guys, look at this weekly bounce. Size of the weekly bounce is very good right now, about 61.8%. So that does give the bulls an opportunity to even reset into a new weekly uptrend. As we know, we lost the previous one by losing these lows right here. So moving on further, guys, tackling IWM Russell right now. So the IWM continuing to advance forward 1.3%, largely as a byproduct of the overall market bullishness. So daily uptrend is continuing right now. Just looking at this point, any pullback, we'll just be looking for a daily higher low. Look at the 1 hour trend, right? So 1 hour, we did temporarily lose the hourly trend, but the bears never set up the hourly downtrend. So even though this looks like a daily higher low, it is not. The true daily higher low is all the way down here, right? So at this point, we'll still be looking for a pullback. Anything pretty much above 204, could be looking for that daily higher low for possible further trend continuation. Where could we come down into, guys? Target this range right here, 210 down to about 208. Big prior resistance for this ETF. Possibly going to be support for it and maybe due for another leg of rally. What are we dealing with to the upside, guys? Coming into big resistance right now, 216 all the way up to about 218. So be very careful about buying here, especially buying into these resistance levels. I'd be more keen on waiting for that retest of the lower support range to possibly initiate any swing trades. And now lastly, the Dow Jones. Dow Jones also not looking too bad here, 0.14% to the upside. Beautiful daily uptrend underway right now. So similar to the rest of our indexes, kind of battling with all-time high above resistance. Going to constantly be looking, guys, for the loss of the hourly time frame. If we lose it in the next few days of trading, you guys will understand that we are in daily consolidation, looking for a higher low, anything above 39,250. daily higher low for possible further trend continuation. I would be targeting maybe the prior all-time highs and our range of moving averages right here, roughly between 40,000, let's call it, and 40,100. This little pocket right here could be a nice area for the bulls to pull back, retest, and maybe on for a future leg higher. The weekly is also looking very bullish on the Dow Jones, continuous weekly uptrend, and the monthly, don't even need to talk about it, guys. Gorgeous monthly uptrend in motion right now. So that's pretty much everything for your indexes right now. Let's move into our big tech names, shall we? So moving into Apple. Apple finally, a little bit of a red day, but only down about 0.05%, right? Barely red, and got it all back in the after hours nonetheless. So Apple still trying to continue this daily move higher, still not having set a daily uptrend though. This is one single daily move. So as soon as this move is topped out, you'll notice that by a loss of the hourly time frame, guys. So essentially, if we were to break today's lows, right, tomorrow, that would be your hourly confirmed downtrend. That would be start of Apple consolidation to the downside. Where could we possibly end up on Apple to the downside? We'll just look no further than 220 down to about 215. This prior support, prior resistance area should be acting as support for the markets once again. So could see a scenario where you just pull back ever so slightly, set the daily higher lows, and then rise. Apple also looking for a potential inverse head and shoulder setup. So watch this one closely. The weekly too is looking very good. Extremely nice bounce by the bulls right now in terms of your weekly size of the bounce. The bounce size is up to just about 80%. So that gives the bulls the best odds that even if we lose this daily uptrend into a daily downtrend, right? Because that's always a possibility. Just understand the bulls probably just looking for a weekly higher low for possible trend continuation. Unfortunately, Apple, you guys know this by now, I really cannot be playing it, guys, just because of the valuation concerns right now. Over a 3 peg is way too high for me that I'm willing to pay for Apple right now, especially considering the fact that the revenue hasn't really been accelerating over the past 6-7 quarters. I like Apple more specifically, more around the 205 down to $200 range. I'm not going to chase it up here, but for a long-term investor, such as I have Apple shares in my long-term portfolio, I'm not selling any. I'm still holding my Apple shares. I'm just not adding any up here, right? So moving on to AMD right now. Give me another very brief second. So AMD, not too bad today, 0.9% to the upside, looking pretty good, but still battling with our overhead resistance, right? In a big pocket of resistance right now, 155 up to about 162. Huge congestion for the market earlier, congestion here as well, prior support. So we obviously know it's going to be a very volatile range for AMD. That being said, two possible scenarios. One is we just push right through this area and then maybe retest it as support before putting in a new daily leg higher, because this is a beautiful daily uptrend right now. Or if we ever get rejected right here, probably just looking for a daily higher low for a second attempt at smashing this resistance zone. Either of those two scenarios, guys, are going to be ones I'm looking at for trading AMD. Going to be patient. Very tough for me to buy here in resistance. We need either a clear rejection from resistance, get some momentum down here. After that, I'll be able to play some short puts, maybe in the lower 140 range. Call debit spreads from this location for a second attempt as well is very good. So I'll be patient to the downside. However, the other situation is a break above and then retest and then run. I'll be waiting for this retest in the event that this scenario plays out. It's just, I like waiting for confirmation, guys. It's very tough for me to be buying in resistance when we don't know if they're going to break through or they're going to get rejected and head lower. So I'd rather wait for a confirmation trade of either of those two scenarios. In terms of the weekly move, weekly is looking very nice, but you can see, guys, how big this resistance zone has been in the past, rather. That's pretty much what's stopping the bulls right now from moving higher. So coming up about 61% of the move so far. So even if we were to lose this daily uptrend into a daily downtrend for a couple of weeks, just understand the bulls do have a decent amount of space here to go for the weekly trend change later on in the year. So I like AMD. I like it a lot more, guys, if we can start getting some short put plays, put credit spreads in the lower 145 to about 138 range. That's my desired area. If not, we wait for the break and retest, and then we'll be playing it down here, right? Moving into Amazon. So Amazon up about 0.69%. They were actually a lot higher today, 182.5, but came slightly down, but that's okay. We have now fully filled the earnings gap. So Amazon with a heck of a rally, guys, from the lows of the Black Monday dip, up 20%. very nice rally on Amazon, which is why I was saying all throughout this period, great time to add Amazon to the long-term portfolio, right? So in the event Amazon tops out here soon, dealing with this overhead resistance area that we're in right now, we'll just understand we'll be looking for a daily higher low. Anything above 152, just looking for a daily higher low, guys. We have not set an hourly downtrend this entire move. This is one single move. They never stop to set the daily higher lows, right? So in the event it tops out, we'll be looking for those daily higher lows. Where could we maybe come back and revisit the 200-day moving average down here at about 170 and these prior little level right here. Also the low of last earnings and the highs of the earnings before that, right? So this lower bound range right here, oops, sorry for that. So let's call it anywhere between 165 to about 170. That's where we could be looking for maybe another dip, a buying opportunity on Amazon. If ever we retest there, could be a great opportunity to be writing some short puts, put credit spreads, and maybe even some call options like call debit spreads, or maybe some leaps I'll be looking at for the recovery of Amazon later into the year and into 2025 as well. I think the company is very well positioned to deal with the economic landscape right now. Moving on to Google now. So Google down about 0.79%. That's okay. Google's still just looking for its daily higher low. So beautiful daily uptrend on Google right now, looking for the daily higher low. Anything pretty much above 159.50, we'll just be looking for that daily higher low for furtherance of the uptrend. Now keep an eye, guys. This is when I tell you to keep an eye on the hourly trend, right? So you can obviously notice that Google has now lost the hourly trend in a significant fashion, right? Yes, we're kind of double bottoming, triple bottoming at this location right here, but we did have a net loss of the uptrend by breaking your prior lows and setting up equal lows as well, right? So daily consolidation underway for Google right now. I'll be looking to buy the dip down here, guys. I'm still looking for some short put opportunities. 162 down about 158, very decent area for Google for me. Even on the weekly here, guys, right? I love this location at the weekly chart. Very good valuation for Google as well. Only a 1.37 peg at 180. So right now it's even lower than that, looking very, very good. So if I can find this one in the lower 160s, higher 150s, right where this 200-day moving average is, and right where they're building a nice little shelf of support down here, that is where I would love picking up this company for a few more shares. All in all, Google not looking too bad though, just hasn't rallied as much as the rest of big tech because of those Department of Justice headlines of the last 2 weeks wanting to break up Google, winning their case, their landmark case with Google's search business and stuff like that, right? So really negative headlines been holding Google back ever so slightly. Now, moving into Meta. Meta up about 1.6%. Meta performing very, very nicely here today. So trying to make an attempt, guys, at the all-time highs. Once again, the all-time highs are 542. So Meta looking to possibly set up the daily higher lows and go for the daily trend change, because this is one single daily move, setting up the daily higher lows and running. It was tying into a situation that I described yesterday, right? Meta poked its head above here. Now it's trying to use the all-time high areas as a little bit of support to possibly manifest into a future rally to the upside. Meta is looking extremely strong, guys. I love this company. If we're looking to swing trade it though, however, right, we need it to break a little bit higher. You need to see a further break to the upside and then possibly retest, just to let us know that we have cleared this area and that we can actually use it as support for a bit more size in our trades, right? Right now, it's still kind of a little bit of an in-between scenario, right? The other scenario is if ever Meta loses the daily uptrend and sets up a new daily downtrend and further weekly consolidation, we'll be looking for a weekly higher low for further trend continuation, and I will be looking to buy the heck out of that dip if it happens, guys. Anything under 500 at this point, right? 500 down to about 475, this location right here. Great buying opportunity for Meta for a long-term portfolio, but also for some maybe put credit spreads and also maybe some call debit spreads right here for further upside leading into the end of 2024 and 2025. So Meta, no red flags at all. The daily's looking good. The weekly's looking extremely bullish, and we don't even have to talk about the monthly. The monthly is just a pure form monthly uptrend, right? Looking very, very nice. Now, moving into Microsoft. So moving into Microsoft right now, Microsoft down about 0.16%. Not the best day for Microsoft, but I wouldn't say it was a bad day either, right? So Microsoft looking very good in the context of this new daily uptrend, but we are battling with overhead resistance right now. 436 down to about 423. This is the area that is slightly holding us back, but we know that Microsoft has a very, very nice dip that was bought by the bulls, and now even an engulfing move and a new daily uptrend. So everything is looking very healthy for them. So at this point, any pullback just going to be looking for a higher low. Anything above 416.24, looking for a daily higher low for possible further trend continuation. But if ever we roll this over here, guys, is everything lost for Microsoft? Well, no, not really. We still do have a decent sized weekly bounce. Take a look at the size of this weekly bounce, just about 50%. So not the strongest bounce in big tech right now, but not a weak bounce. 50% is very decent, and it does give the bulls an opportunity to potentially set up for a weekly higher low for further trend expansion. Now, if Microsoft, for some which reason, comes back down below here and gives us an entry opportunity at the 410 level or less, I will be looking to write short puts in the lower 400s. Think 400, 395 on a weekly basis, maybe even some put credit spreads, 385, 380. Those levels are good. And maybe even some call debit spreads for some upside leading into the end of 2024 and 2025. All in all, though, Microsoft bulls are looking very, very good right now. The weekly recovery is looking good. The monthly chart never lost the monthly uptrend either, and the daily is still looking strong. I will be waiting for a little bit of a pullback, however, to add to any Microsoft positions. Now, but still, great position in terms of swing trades, right? But still, for a long-term portfolio, I don't see any problem really of adding Microsoft up here. Now, moving into Netflix. Netflix also continuing to have very, very good days. So only down about 0.2%, but got it all back in the after hours right now. So very, very flat on the day for Netflix. But look at this massive move they've had in the last 10, 12 days, right? Now still battling with the prior all-time highs. They're still not above. They broke above yesterday temporarily, but still not above that ever so elusive $700 psychological level. So we'll be watching for a breakout like that on Netflix in the next few coming days or weeks. I think it's definitely going to happen, guys. As soon as this move is topped out, we'll just be looking for a daily higher low. Anything pretty much above 586, just going to be looking for that daily higher low for possible further trend continuation, right? Target these levels right here. We are pulling back now. We could be pulling back to the top end of this range, which would be roughly 670 down to about 650. And then obviously with a larger level of support, if in the event the markets fall off here a little bit and consolidate, we end up with a daily downtrend on Netflix, probably just looking out for a weekly higher low for further trend continuation, and that would be all the way down to about 650 to 630. So essentially a lot of support below us here, guys. I would get more interested in this one if I can find any premium writing options contracts between 655 and 630 to the downside. But right now, no red flags at all on Netflix. Company's looking extremely strong. Moving into NVIDIA now. So NVIDIA up about 0.98% to the upside, looking quite decent as well, especially leading into its earnings next Wednesday. Still not pulling back, however. I'm waiting for that pullback, but it's just not coming here, guys. I just want a little bit of a pullback so I can make an earnings play long. So daily uptrend clearly underway right now on NVIDIA, possibly looking for a daily higher low as soon as this move is topped out. You can see here, guys, really just caught at a tightening range at the top. If we lose this into an hourly downtrend, you will know that your daily consolidation is underway. And then we target the lower end of the support down here, roughly 120 down to about 115. Possible setup for a daily higher low, and then possibly run into earnings. So I'll be on the watch for that in the next coming days. On the weekly, we know that we were in a weekly downtrend, and now the bulls, for all intents and purposes, have engulfed almost the entire move, right? Over 80%, looking extremely strong there. So I'll be waiting for a play before earnings, guys. That is the only play that I want, and probably going to sell out half prior to earnings. If I can get a dip in the next couple of days, I'll be making a play here to ride up into earnings, then probably selling half for earnings and riding the other portion into earnings, right? And if for ever which reason their earnings are not well received and we dip back down into the 110, 105, I'd consider making some swing trades on NVIDIA down there too. Now moving into Tesla, Tesla up about 0.98%, not too much of a change on Tesla, right? Still in a very nice daily uptrend for the bulls right now, looking for a daily higher low, anything pretty much above 192, just looking for that daily higher low for further trend continuation. Where could we possibly come back into if the market movement stays normal? Possibly these moving averages right here, 215 down to about 205, seems like a nice little pocket for a retest and maybe continuation of the run. In terms of your weekly is not looking too bad at all, right? We know that all the momentum was lost right here. Now, probably the best case scenario for Tesla is being able to maintain somewhat of a tightening range. I would be excessively surprised if we can V-shape move this all the way up to the $300 level. I do not think they have the momentum or, quite frankly, the catalyst to do that quite yet. They do have that robo-taxi event in October, but before then, we don't really have much in the ways of news for Tesla. So I will probably be looking, if we do get a pullback here in the lower maybe 205, $200 range, then we'll probably free up some premium, writing some short puts down maybe in the 180, 175 range. That's really where I want to be playing this company myself specifically. Chasing it up here, guys, in literally the midpoint of this entire swing. Not the best risk to reward proposition in my opinion, which is why I need it to come lower so I can maybe get some of these levels down here, right? And lastly, Palantir. Palantir moving nicely today, 0.68% to the upside. No red flags whatsoever, right? Palantir is just really consolidating above this previous zone of big previous resistance for the stock, right? $30 to $29, huge level in 2020 and 2021, and now we haven't even bothered retesting it before maybe attacking the higher level of resistance, which is the 35. So Palantir Bull is looking excessively strong right now. For all intents and purposes, guys, these 3 days of consolidation, this is a bull flag and looking to possibly gain even more levels. However, if the move is topped out right now and we start losing some of these gains to the downside and we get a little bit of daily consolidation, just understand anything pretty much above 21, just looking for a daily higher low for further daily trend continuation. In the event we pull back too much, set up for a daily downtrend, something like that, can't get it done, just looking for a weekly higher low, right? Gorgeous weekly uptrend, going to be looking for a weekly higher low for further trend continuation. This is the move that I'm waiting for on Palantir, guys. I may have to wait for a long time, but don't worry about me. I have long-term shares that I bought back here in my long-term portfolio. But for a swing trade, I'm looking for a pullback here, $29 to $28 range, looking to play that breakout, retest pattern and run. So this is the one that I'm waiting for specifically, because if it comes down here, then it frees up some premium at the lower strikes. Think $27, maybe even $26, right? So that's the move I'm waiting for on Palantir, but the bulls in full control right now, guys. Very massive move by them. Take a look at this move here, guys. What a monster move since their earnings, guys. 53% to the upside. So that's pretty much everything we had in terms of our stock rundown for today. Hopefully you enjoyed that. Now let's jump into my portfolio to see the trades made today. All right, guys, so going over the portfolio right now, before we get into the positions that we still do have and the new ones, let's go over a few of the ones that we closed, of course, as per usual. And as you can see here, guys, in terms of the early morning, we just closed a bunch of earnings plays that we had from yesterday. So we had a target short put for this week and then also a long put for next week. It was an earnings play with a bit of bearish lean to it, and it only cost us a net amount of $7. So we collected $20 on the short puts, and the long puts cost us $27. Now, obviously, because target went up, both of those unfortunately are worthless. So we just lost a big $7. That's why I like taking some of these earnings plays, guys. You will notice that most of my earnings plays, I try and make them as cheap as possible, especially when I'm picking a certain direction, right? So that was a very nice trade on target. The ADIs as well, we had those for earnings yesterday. As you can see, we pretty much opened the ADIs. Where can I find them? Can I find them right here? Let me just check. There's too many trades here, guys. Too many trades. Sold a put here, 202 and 50 puts for 40 cents. We closed those almost worthless. ADI earnings were pretty good, so we were able to close those this morning very early for almost 95% profit. Looking very good there. That's pretty much one of the only trades, the only two trades that we did close here today. We opened a lot of them. We also closed the American Steel Corporation, the X puts, right? So we got these $37 puts at $30. We closed them for $15, so 50% profit in 2 days of trading. The only reason I closed these guys was to open some buying power for other earnings trades that I wanted to take. The 36.5s, we got them for $20, closed them for 10. So another 50% profit there as well. Not that much profit, guys, but still 50% is 50%. And the trade just performed exactly as we were looking for it to do. Now into ASML, we also closed 2 shares of ASML. The reason being, it just respected our trade criteria. So we had bought ASML, we had bought 4 shares 2 different times, right? So we bought some shares on ASML when they had their initial drop after their earnings, when they were trading roughly at the $935 mark. Then when they got absolutely destroyed down here, we picked up a couple more, ending up with an average cost of right about, let me just put a line on it, right about here. $877 was our average cost. And I was saying that if we were to pull up into this overhead resistance zone, I would cut a little bit of the position. And then as we move higher towards the $1,000 mark, that is when I'll close the other half of the position. So far, so good here, guys. We closed these shares at pretty much today, just over $940.36. So we made some very decent profit, right? Let's call it about $65 times 2 shares. That was about, $135, $140, something like that. all in all, very decent performance so far. In just a couple weeks of trading, that was a very nice gain. 940 divided by 877, that's pretty much a 7% gain in just a week and a half, just about 2 weeks of trading. So very good. I'll take that. Still have half the position on anyways. Those are pretty much the only ones that we closed over the course of the day today. There's a few other earnings plays we had yesterday, but I'm riding them into the end of the week, and I'll explain as we move through these positions, right? So you'll see a lot at a first glance, but a lot of these guys are really just earnings plays. So we have AAP. So these are also both earnings plays. We have the 48 puts for pretty much Friday. We got about 16 cents for them. We'll see. That is well above 2 standard deviations, guys. So AAP, this company has gotten absolutely destroyed in the past couple of years of trading because of some accounting that went wrong for them, unfortunately. Very long calculation, but to say the least, guys, they just have not been performing the best in terms of their internal fundamentals. Now, we are at $48, guys. $48 would be a decline of roughly, from current share price, 24%. The expected move on AAP, let me just pull it up for you guys real quick. That's Apple, that's not AAP. So let me just pull up AAP, and you'll see, guys, always going for 2 times the expected move. So you'll see the expected move about 11.5%, and we're all the way down at 24. So this one should be a profitable play. Anything can happen, of course, but at $48, guys, I might just be willing to just keep these shares and ride them out. So we have 2 different contracts, one for this Friday, one for next Friday. That way, if the company beats results and either is flat or higher, we'll be able to realize a lot of next week's gains by tomorrow morning as well. That's why I kind of staggered these 2 ones in terms of the expiries. In terms of other new trades for today, we took some Baidu. So not only do we have Baidu earnings plays, once again, one for this Friday at the 81s, $26 we got for that one, and the 82s for next Friday. Once again, if Baidu either stays flat or goes slightly down or rises, we'll be able to realize a lot of next week's premium by tomorrow morning. That's why I took them for about 70 cents on that contract right there. And we even have a directional play for Baidu, a bit of a longer one. These are for October, so still 2 months out. We went with the bull call debit spread. We paid $1.32 per contract, 2 contracts right here for the 95s versus the 100s. So still a little bit out of the money here, guys. We're just looking for a potential stock rally in the next 2 months to bring us maybe into that mid $90 range. Not that much share price appreciation that we're going for, right? Only going for just a couple percentage points. Let's call it about 3, 4, 5%. Should put us slightly in the money on those, and we should be able to clear a nice profit on these. We're looking to close these probably around $220, $230 per contract. So that's pretty much it for the Baidu trade. Still have the Bitcoin trade, still have the CELH short put, which was a wheel trade for this week. Gonna ride that to the end of the week. We also opened some CP bull call debit spreads too for the month of December. So a lot of time left on these. 3 contracts, $75 each. We'll probably look for a 2x on these. We're just looking for a potential breakout of this massive range of accumulation that CP has really been in for pretty much the past 3 years of trading, right? So I gave myself a lot of time on these contracts to really go for this breakout. Value stocks have really been doing well recently, so I do expect some love to come to CP. Once again, we are looking for the 85 versus the 87s, which is not too much above the current share price, guys, but still, it is still above there. So that is just a play on CP. We also have some CSIQ short puts for earnings, the 12.5s. We got 3 contracts there for about 10 cents, decent premium, and the $13 puts as well. These are both for next Friday. So looking for CSIQ to either drop a little bit or stay flat or rise. If that's the case, we should be able to take most of this profit on these contracts come tomorrow morning. They have earnings tomorrow before they open. I'll remind you, I was in CSIQ. A few of the veterans on the channel probably remember this play, right? We got assigned CSIQ all the way back here, right? 35, wrote it down, and we took a $1,492 loss on 400 shares. After bringing our cost basis down so much, we ended up selling for a loss at 21.41, bringing our cost basis down to 25. And now we're pretty much half of that, almost half of our cost basis. So that was a good little, taking the loss, unfortunately, when a company runs against you, right? Now it's significantly lower. If we can get some deep value, right? Maybe down in the $13, guys, that would be prices from 2018, maybe all the way even back to 2017. Those could be good prices. I would not mind being assigned shares down there, which is why I wrote those strikes on CSIQ. Then moving down forward, still have the Deere position, the Disney position, Domino's Pizza for this Friday. This one should be expiring, probably worthless, right? Domino's Pizza performing very well at 427, and we would only run the risk of losing money if it closes below 410, so should be safe on those. EVVTY still have those. Let's take a further look at some other things. Moving on down. So we do also have the Microsoft positions, no change there. NTES, that is also an earnings play for, we took the next Friday contracts, but this is also a 2 standard deviations from the expected move. Should be able to close a lot of this profit by tomorrow morning if the company has favorable earnings. NTES, right, that massive range of accumulation, $83 is literally right about here, right? Oops, that's not the right one. So NTES, just going to show you guys once again how I choose my earnings plays. So NTES is about $83, is right there. Lower end of a massive range of weekly support and is 2 times the expected move. So let's just pull it up so you guys can see, right? So NTES, is it going to load? Yep, let's go. So NTES, the expected move is 5.3%. So we are literally about double that, at about 10% to the downside here, just in excess of 10% at the 83. As a matter of fact, it is literally 10.37%. So we should be pretty much 2 standard deviations away. That's pretty much it for that one. Still have the OXY short puts for this Friday. We'll see if we get assigned those or not. It's roughly around $56 now. We opened some PayX bull call debit spreads. We got one contract, paid $180 for it. Going to be looking to close this one maybe $250, $260, $270 to the upside. You know, we got this contract, guys, got a decent amount of time on it. These are for November, so 3 months worth of time, at least about a nice little 3 months worth of time. Just looking for the breakout of this massive range, right? We got the 130s versus the 135s. They're not that far away, right? Very, very close to the money. If we get any form of breakout to the upside, that'll probably do it, and we should be in profit for this one. So as you can see, guys, when I take call option plays, especially recently, sticking to the call debit spreads. We also did the same thing for Qualis. So Qualis, we have 2 contracts, paid $175 per contract. We have the November 130 versus 135s. Qualis, very solid company, somewhat of a small company, only about $4.5 billion market cap, but extremely profitable, growing well, and we're coming into a very large area of support. Call that with being in weekly oversold conditions, guys. This is one that I like for a call option play. So I gave myself a decent amount of time, gave myself 3 months, and we're not so much above, right? The 130 to 135s are pretty much right there. Not that far out of the money, right? Only maybe about 5% for our long strike, excuse me, to be in the money. So these should perform quite well. Looking forward to them. Snowflake, we took the August 30, so next Friday, $100 short puts for earnings. Those should be completely worthless tomorrow. We should be able to close these for a massive gain. We also took some SoFi plays. I'm just maybe looking to be assigned at $7. Not so much premium, guys, right? It's a very cheap stock, so can't expect to get too much premium on these. Just got about 5 cents minus commission, so $5 a pop, $20 play, you know, just looking to get assigned 400 shares at $7 and maybe ride it a bit higher. We also got a tiny little SQQQ play on only 2 contracts, just looking to milk a little bit of the volatility. If ever these news events come in less bullish than expected, and we get a slight decline in the QQQ after such a substantial rally, well, that may be a good opportunity for us to profit on some SQQQ plays. Very, very tiny position though, guys. We still have the SYMs for Friday. Those should be good. Those should expire worthless. Toll Brothers, these are a play from earnings. They are completely worthless right now. I had a bid order right here at 2 cents all day. They never filled me, unfortunately. So that's a problem right there. And then lastly, we still have all the other plays too, right? We also have some Urban Outfitters that we took after earnings here for $34 put. So Urban Outfitters with their earnings today after the close. Let's have a look on them. So we had our puts right here at about the, as I was saying, $34 range for this Friday, only $15 play. And now they're about $37 right now. So we should be good here, guys. We went 2 times the expected move. 34 is all the way down here. Should be good for that Friday expiry. Wouldn't be surprised if this is almost worthless tomorrow. And then we had Wolf, another play that we took in the after hours for earnings today. Wolf Speed, we were looking for a very large move on Wolf, right? The reason being is that we took the $9.5 puts. We got $15 for each of those contracts. 2 contracts. That was a massive move. And Wolf right now in the after hours is up about 6.29%. But that would have been a heck of a drop here, guys, on Wolf from there to about $9.50. That would have been a drop of 30%. That was 2.5 standard deviations. I got great premium on them. The company's been absolutely destroyed over the past couple of years, right? So I was looking to really cherry pick the bottoms of the dumpster, as they say, right? So those are pretty much all the positions that we maintain and that we have for the rest of the week. Been a very good week playing earnings and very small wheel trade strategies. generated a lot of premium over the course of the week. And then, guys, we filled up the secondary portfolio. So this is the dumpster dive time machine portfolio. I call it the recovery story portfolio because in essence, all of these companies are trying to go through a little bit of a recovery story. So we built a lot of it yesterday. I asked you guys for some recommendations and finalized the portfolio today. So now we have 20 names, $50 each, and we're just going to let them ride. So now we added Southwest Airlines, another company that's been absolutely crushed right now. So we are now back to, for all intents and purposes, 2014 prices on this one. That's why I liked it a lot. It was between that one and American Airlines. I went with LUV just because they do pay a dividend. American Airlines suspended theirs. And moving on further here, guys, we went with 3M, so some shares of 3M right here. Then we also went with some PayPal. Even though PayPal has increased substantially over the last 2-3 weeks of trading, they're still crushed in relation to what they used to trade at, $200-300 range, right? So we picked up a little bit of PayPal, $50, and then we went with a legacy company, AT&T, right? So AT&T has been the topic of debate. Is it a value trap? Is it a great play? Well, we're going to find out here, guys, whether it's a trap or not. We got some good pricing down here. You'd have to go back to pretty much either, 2022 or the lows of 2009 or even 2002 to find such pricing on AT&T. So we took them, pay a decent dividend. So we will see how this portfolio goes. It is now fully constructed and we're fairly decently diversified. A lot of these plays are retail facing trades, but we have a lot of diversity amongst them nonetheless, right? Baba, Carnival Cruise, Caesars Entertainment, Dollar General, Disney, Estee Lauder, Helen of Troy, Intel, Southwest Airlines, 3M, Nike, Pfizer, PayPal, Papa John's Pizza, Stanley Black & Decker, AT&T, UPS, Walgreens, Whirlpool, and Wynn Corporation, Wynn Resorts and Hotels, right? So all in all, I'm fairly happy with the way we've constructed this one. We went for companies on extreme dips, and now it's the time to see over the next year or two, will this portfolio outperform the S&P? Now, we're obviously not expecting guys to 10x this portfolio, right? It is just an experiment to derive whether or not it is a good proposition to be buying these companies when they are being destroyed, significantly underperforming the indexes. Are they going to be able to outperform the indexes if they come back over the next 1 to 2 years? That's pretty much everything I had for you guys today. Hopefully you enjoyed today's video. If you did, consider dropping a like. Would appreciate it for the growth of the channel. Also consider subscribing to the channel if you're new. We do these videos every Monday to Friday after the close. Hope to see you back in a future one. And as usual, guys, if you have any questions at all, please feel free to leave them down below in the comments and I'll usually get to you within the next 24 hours. Anything you want, if you want to talk about a stock, an options play, technical analysis, macro discussion on economic news, anything you want, leave it down below and I'll get back to you as soon as possible. Take care, guys. Have a great day of trading tomorrow. See you after the close. Peace.